Ladies and gentlemen, good day and welcome to the India Shelter Limited Q2 FY26 earnings conference call hosted by ICICI Securities. As a reminder, all participant lines will be in the listen-only mode, and there will be an opportunity for you to ask questions after the presentation concludes. Should you need assistance during the conference call, please signal an operator by pressing star, then 0 on your touchtone phone. Please note that this conference is being recorded. I now hand the conference over to Mr. Renish Bhuva from ICICI Securities. Thank you, and over to you.
Thank you, Shu. Good evening, everyone. Welcome to India Shelter Q2 FY26 earnings call. On behalf of ICICI Securities, I would like to thank India Shelter management team for giving us the opportunity to host this call. Today, we have with us the top management team of India Shelter, represented by Mr. Rupinder Singh, MD and CEO, Mr. Ashish Gupta, CFO, and Mr. Rahul Rajagopal, Head Investor Relations. We now have the call to on to you, sir.
Good evening, everyone. On behalf of the company, I extend a warm welcome to all of you. Thank you so much for joining us on the call today. Let me start with some broad macro updates. Headline inflation is expected to stay towards the lower end of RBI's target band in 2025-26, after experiencing significant moderation during H1 financial year 26, mostly as a result of sharp correction in food prices. Despite flooding abroad, excessive rainfall in number of states, the prospects for agriculture industry remain positive. Educators are available, helpful policy actions, and other normal monsoons in the majority of regions all contribute to this promising outlook. With significant increase in sales of fast-growing consumer items in rural regions and positive sales of tractors and motorcycles, rural demand is expected to stay solid. GST 2.0 reforms are expected to further boost private consumption and domestic demand. And high festive sales volume and consumer emotions already indicate a revival in household discretionary spending in both rural and urban areas, which should help credit expansion in upcoming quarters. The growth outlook is still supported going forward by reduced inflation, increased credit stabilization, favorable financial conditions. In the short run, the government's persistent emphasis on capital spending, GST changes, and bettering lending conditions should increase aggregate demand and support the sector's strong momentum with robust loan demand. On that note, let me move towards the quarterly update of India Shelters. We are pleased to announce that the company delivered another quarter of performance. We delivered an AUM growth of 31% year-on-year, reaching an AUM of rupees 9,252 crores. In Quarter 2 Financial 26, we disbursed 931 crores, registering a growth of 12%. In Quarter 2 Financial 26, we added 9 new branches as a part of branch expansion strategy. Geographic presence stood at 290 branches as of 30th September 2025. Gross Stage 3 and Net Stage 3 came at 1.2% and 0.9% as of 30th September 25, as against 1.2% and 9% same year last year, 30th September 2024. On profitability metrics, PAT for the quarter came in at rupees 122 crores, registering a growth of 35% year-on-year and 2% quarter-on-quarter. Return on equity stood at 17%. Our net worth now stands at rupees 2,914 crores. We continue to see demand and growth potential in the affordable housing market in Tier 2 and Tier 3 cities, supported by government policies. Our guidance remains same. That is branch addition of around 40-45 year-on-year, of which we already opened 33 in this financial year, that is H1. Maintain spread of more than 6% in medium term. Credit cost around 40 to 50 bips and loan growth of 30-35%. Now I would like to hand over the call to Ashish Gupta, our CFO, to take you through the financial metrics. Over to Ashish.
Good evening, friends. Let me take you through the key financial numbers. We have ended the quarter with AUM of 9,252 crores. Year-on-year growth in AUM is 31%, quarter-on-quarter growth is 6%. Total income for the quarter is up by 30% year-on-year, largely driven by 31% growth in AUM. Our portfolio yield is at 14.9%, which is stable year-on-year basis. Our disbursement yield is also running at same level. On funding side, we have diversified borrowing with more than 30 counterparties. Average maturity tenor is at about 8 years. Our market cost of funds is down by 10 basis points in Q2 to 8.5%. Total reduction in cost of funds last 9 months is 30 basis points. Our margin cost of funds for Q2 is at 8.1%. Thus, we expect to see another 30 basis point reduction in the bucket cost of funds by year-end. We have received sanction of 550 crores from National Housing Bank, which we expect to draw in next 2 quarters. Further, we have received a sanction of 500 crores from SEBI for the first time. This will help us to further diversify our sources of funds. Our lending margins are consistent above 6% in line with the guidance for medium term. Net interest income is up by 33% year-on-year, 5% quarter-on-quarter on the back of growth in our AUM and improvement in spread. Coming to OpEx, our year-on-year growth in OpEx is lower than growth in AUM, resulting in better cost ratios. OpEx to AUM for the quarter is at 4.1%, down by 30 basis points year-on-year. Cost to income for the quarter is at 35%, down by 170 basis points year-on-year. On asset quality side, stage 3 is stable at 1.2%. Our credit cost for the quarter is stable at 0.5%, in line with our guidance for medium term. Net stage 3 asset is stable at 0.9%. PCR for stage 3 asset is stable at 25%. Our total ECL is 73 crore against the regulatory threshold of 43 crore. Thus, we have adequate buffers are in place. PAT for the quarter is at 122 crore, year-on-year up by 35%. ROA for the quarter is 5.8%, up by 20 basis points year-on-year. ROE for the quarter is 17% on annualized basis with a leverage of 2.9 times. On liquidity side, we are comfortably placed with a liquidity of 580 crore and undrawn sanction of about 1500 crore. Our ALM is positive across all the buckets. With this, I conclude, and now we can open the floor for Q&A.
Thank you very much. We will now begin the question and answer session. Anyone who wishes to ask a question may press star and 1 on the touchtone telephone. If you wish to remove yourself from the question queue, you may press star and 2. Participants are requested to use handsets while asking a question. Ladies and gentlemen, we will wait for a moment while the question queue assembles. We'll take a first question from the line of Raghav from Ambit Capital. Please go ahead.
Hi, good evening, and thank you for giving me the opportunity. I just have 2 questions. One is, what is the bounce rate for the quarter, and if you can give me a split by housing and non-housing book? That's my first question.
So bounce rate is into tune of 20-22%, which happens. That is on quarter-on-quarter. Sometimes if there is a weekend Sunday or something, it goes spikes by 1 or 2%. Otherwise, range between 20-21%. That is something we keep maintaining around, basically.
Okay, and what was the split between housing and non-housing in terms of bounce rate?
So there is no difference between the bounce rate between the HL and LAP. So broadly, we are catering to self-employed segment in both the loan product category. So there is no much difference between the 2.
Understood. Second question is, a couple of affordable housing finance companies which have reported yet have shown some stability come through. What are your thoughts on the industry collections and asset quality, given that even your stage 2 ratios have gone up? Just some of your thoughts will be very helpful.
So I think last 1.5 years is discussion which is running around this piece particularly, and there's an obvious reason because of overall industry to see not only affordable housing, but when we talk about rest of the products, the MFI sector unsecured, so there is a heat around that piece. And if there is a heat around piece, you will always find that one product in other way, some other way, do impact the overall ecosystem basically. So there's a slight stress, but having said so, affordable housing companies do have a one strong support in terms of getting selection fast, quicker and better in that piece. And this is a reason that even if customer faces and moves to further stage which is 90 DPD and above GNPA level, the opportunity with the affordable housing company, they have always there to bring it back. So little bit up and down that keep coming. It's a long-term business, so every quarter can't remain the way it is earlier one. But yes, I think most of them are in the range bound basically.
Understood. Just for second half, what kind of disbursements are you budgeting? Your second quarter disbursement growth is only 12%. It was trending at 25-30% before this. So how are you thinking about disbursement in the second half, and then will you still stick to a 30% growth guidance even for the year?
I mentioned in my early entry that we will going to maintain this growth rate of 30%. This quarter, technically, like we and people connect over that, I think. But I hadn't what at the profit and the money that has been built, that completely remained there basically. So that is we can easily that happening in some goals.
That's all from my side.
Thank you.
Thank you.
I think the next question from the line of Darshan Deora from Invest Group. Please go ahead.
Yeah. Firstly, congratulations on a great set of results. And actually, the question I also had was on disbursement, but you already answered that. So hopefully the disbursements will pick up in the second half.
Yes, so it's normally a trend which has been seen in history also. Also for not only myself, most of the companies are I think the government continues to be, optimistic compared to the election. Actually, has many pressures, reasonably in the acting law that we've seen them those things. So I think there is no reason that we should have a caution on that this moment is not going to come up. So very actually, as it's being middle of almost there, we can see that this section is coming back in terms of taking to the, annual numbers keep going on. But I think if we go like forward-looking statement, but always still find better than actual in that sense.
Appreciate that. Thank you. And again, great set of results and congratulations to the entire team.
Thank you. Thank you so much. Thank you, Darshan.
Thank you. We'll take our next question from the line of Sonal from AMSEC. Please go ahead.
Hi, thanks for the opportunity. There has been this question earlier, but just wanted to check how was the collection trend in October? And also, disbursements were slightly slow, not just for you, but for the entire industry. So how is the demand per se? Is there any challenge in demand? You just answered that partially saying that PH is better. But anything that we are seeing on the demand side, and also, if you could talk a bit about the rejection rates, how they were in Q2 this year, and how was it, in the previous year?
So if you talk about demand, which comes in form of new customers coming for logins and all, I think challenges coming around that piece. But as last 1.5 years, everyone has tried to stringent their norms. Definitely that has reduced certain amount in terms of sanction rate for me as well as most of the people which we keep also hearing along with you guys basically. Going forward, as we see that, a trend looks that is going to some more couple of months, and I think should going to come back because August was not a great month to have basically, if you ask me. But as we see September coming up, recently, well, that was a quarter. So this is the beginning of next quarter. So I think we'll be able to come back, as per the trend what we have seen this history year or 2 years or 3 years back basically.
Okay, and that's context for the quarter.
Thank you.
Thank you. Next question is from the line of Shweta from Elara. Please go ahead.
Thank you, sir, for the opportunity. So a couple of questions. So could you throw some light on the LAP portfolio? How has been the FOIR now, and how are we distinct vis-a-vis industry? Second is also, you sort of alluded to this, but still, just don't mind me harping on it. So 30 DPD has spiked to 4.7%. Even stage 2 has spiked, but we've not seen much of movement in our PCR or ECL provisioning. So if you can provide color there, and also any sort of customer cohort or ticket size or region-specific challenges. I remember last quarter you sort of pointed out Gujarat, Uttarakhand growing slower, and certain certain sort of challenges in particular markets. So if you can just throw some color there. And lastly, just a data keeping sort of a question, like what is the attrition rate? Yeah, thanks.
Yeah, lots many questions, and if I miss something, please point me out in between, Shweta.
Sure.
So, if you talk about lab per se, we try to focus again. The norms are not very different, where the FOI in terms of 50-55% and LTVs are lower than 50%. That is for the lab portfolio. Our focus largely in this tier 2, tier 3 market that continue to remain for the self-employed segment. Most of them who are generating their own incomes in those markets by serving those vicinities and all, that continue to remain there particularly. So this is a focus area particularly. So if you talk about month on month, we are observing that in some months there is a spike which is coming, some months it's dull, and there can be various factors around that. Sometimes it's a monsoon, sometimes multiple things. But our thought is not to go break into month on month pieces. It is ultimately to continue to remain in that segment of 30-35% of growth. That we are committed and that we are focusing on directly per se. You talk about some terms of stage 2, right? For stage 2, can you take it up what he exactly said, what the number she was talking about?
So can you please come again?
Can you repeat, Shweta, once again?
So both 30 DPD as well as stage 2 saw some material spike, right? And we've been seeing this trend formation like over a year now. So any customer cohort, any specific ticket size or any geographic challenge you want to attribute this to?
So I can give this, yes, there's a 20 bits hike than the previous quarter, or this is hike, this is there particularly, but as we see this correction coming in the month of September back, as I mentioned, the numbers were little not as great much, but as we see that, we feel that it is going to be sticking around this little bit more, 4.10 to 4.5 or something like that. That's what we see so in current time. But let's see how the things come around basically. So we don't see any problem proportion of something that we to worry about it. So this some that also passing through, we cannot get people to pass on. So I don't think that we have to read very much large number of this between the lines.
So lastly on the attrition rate, attrition
remains constant in the same range. What is we are observing in last year or 2 years. In fact, today's board has been to approve the numbers that what we discussed last time, include all the land managers under the use of stream. So almost 30.5 lakh of stock options will be given to the branch and the level. They will going to increase into almost 500 new employees in the shop pool, which is a pretty large time to cover them in the scheme. Normally the frontline staff which includes branch managers, branch collection managers, and good performing branch managers. I think this is the thing that we are using, and we are hopeful they should going to support in one way or other way for the efficient side also.
Perfect, sir. Thank you so much, and congratulations on a good quarter.
Thank you. We'll take our next question from the line of Renish Bhuva from ICICI Securities. Please go ahead.
Yeah, hi sir. Congrats on a good set of numbers, especially during current time. So my question is actually related to that thing. So we have more than 40% shares between 5 to 10 lakh rupees ticket size, and most of the players, especially in the land segment or a few of them from the affordable housing segment as well, are highlighting stress, or they have changed the strategy to disperse on the stop below 7 lakh rupees ticket size loans, which essentially means that the stress in that segment is relatively higher. So what is the asset quality performance of this particular pool, and also how confident you are that over next 2 to 3 quarters this segment should not sort of result in a high credit cost and what way it is currently?
So Nilesh side, if we compare the same quarter compared to the last year, typically in this ticket size, what we're talking about 5 to 10 and around that piece, our numbers largely remain same, that piece. I can understand that few of the institutions which may not be part of housing finance company, they might be finding this problem, because this is a point of discussion which happened many times in past also, that if you don't have a certainty right, then there is always a scope of struggling rod at least. So I think that challenge does come because those rights are not for the institution which are not a housing finance company or the bank. So they find this kind of challenge while doing that piece. So yes, if there is slight stress, that stress percolates to the more intensity if you don't have a tools to control that piece. So fortunately, as a housing finance company, there are some role which has been played by the SARFAESI that way to curtail that piece. So that remains almost same when we compare year on year. Same September number continue to remain the same number when it's above the 90 degrees.
Got it. Okay. So, concluding this, I mean, we don't foresee any risk from this pool in coming quarters.
So we are confident with this pool. We are not stopping it because we get a better yield and the market will be okay tier 3, tier 4. Self-construction houses, someone who wants to experience more. There's quite a few cases where we get this opportunity now.
Got it. And this last question on the regulatory front, right? So we have already touching 70%, been succeeding in the from last 2 quarters. And now, given your growth rate of 35%, leverage your where do you see ROE setting in near term?
I think there are many aspects to that piece. But I think what we not something we just focus on ROE alone. So the guidance we can take on the 3 points and we can easily calculate to make it up. So we want to continue where credit cost remain in the same segment of 40-50, that's our cost, and again going with the growth of 30-35%. So more than focus, our objective is more on operation side. But what is running around, I think that is something which doesn't look out of scope. It's quite negative. So we don't want to comment on how we work it, but I think in the range for where is the expectation around.
Got it. Okay. That's it from my side, sir. That's all.
Thank you.
Thank you.
Take the next question from the line of Shripal Doshi from Equirus. Please go ahead.
Hi, sir. Thank you for giving me the opportunity. My question was pertaining to the BT out rate for the quarter. If you could give the detail.
Yes, I think when you see the market trends are a little tough, you always find there are some green shoots also, and I think BT out rate is one of that. What we're realizing, BT out rate is curtailed well, decent in the range bound, what we talk about. I think that is a range 4.5% of BT out range, what we can see around basically. That is the thought, which is comparatively slightly better than what it was a year back or 2 years back.
Okay. Got it. And sir, on the cost of fund side, so how do you see that number ending for FY26? And what % of our bank borrowing is linked to repo and T-bill? So how do you see that benefit flowing in on the cost of fund side, and where do you see it ending for the full year?
So on the borrowing side, about 32% of the borrowing is linked to repo rate or T-bill, wherein largely the benefit has already flowed in. And remaining borrowing, about 15% of the borrowings are at fixed rate, and rest of the borrowings are linked to MCLR rate, wherein the benefit is coming in a very gradual form. But the good part here is that if we see our bucket cost of fund, that is at 8.5%. Incremental borrowings are running at about 8.1%. So the blend of the new borrowing and the old borrowing will keep changing. So we expect that by the year end, we should be having a 100 basis point reduction in our overall bucket cost of fund.
Okay. So further 20 basis point of benefit is what we expect for the full year. All right. So that is it from my side. Thank you so much for answering your questions.
Thank you. Take our next question from the line of Subhranshu Mishra from PhillipCapital. Please go ahead.
Hi, can you hear me?
Yes, please go ahead.
Right. I have a question, so just wanted to check on the BT out, or what is the percentage of the units goes up on a monthly basis? What's the total fees?
I'm sorry, your voice is not very clear, Subhranshu. Can you use your handset mode, please?
Yeah, Shubhranshu. So BT out as a percentage of average AUM is in the range of about 4.5 to 5% briefly, and that is consistent in last 2 quarters. But if you compare it year-on-year level, it is down by about 100 basis points.
Okay. And do we have a dedicated team to arrest this attrition?
Yeah, so we have a centralized team who is engaged in the customer retention. So whenever we come to know that customer is looking out for loan, our team proactively connect with the customer and try and retain the customer.
Okay. And what is the major reason of still the people who are going out? Is it just the drop in interest rate because they again have to pay a fees any which ways for the loan, right?
Very difficult to judge that at the moment when he's moving out basically. But largely there are 2 reasons. One is going for the more loan amount, and yes, obviously rate drop is also the option which is there. And when you are opening these markets, there are nationalized banks and all, which does operate at very, very lucrative rate. That's an option here. So irrespective of paying fees again and all, the regulation is good enough to move on from it. Right.
Understood. And you have spoken about the national banks. Are these guys also chasing us in treasury to take up loans? Are they coming up with cheaper pricing for us? What is the calculation of the cuts till now for us?
So if you talk about PSU Bank specifically, so PSU Bank, if you see the borrowing are linked to MCLR, and there is not much movement in the MCLR of PSU Bank at this point of time.
Right.
So the benefit of rate cut from PSU Bank is limited to about 20 basis points per day. But we expect that as the deposit ratio in the new annual will keep changing, the benefit will keep coming gradually over the year. And so as and when the reset of those borrowing will come, the benefit will keep coming on that borrowing.
Have they become more, both PSU and private banks, have they become more aggressive towards that treasury?
Liquidity in the overall market is, quite good at this point of time. So everybody is looking for, quality lending. So we are seeing, good aggression from the bank side to fund at this point of time.
Understood. This was very helpful. Thank you so much.
Thank you. Next question is from the line of Abhijit Tibrewal from Motilal Oswal. Please go ahead. Abhijit, your line is unmuted. Yes, please go ahead.
Yeah, hi. Good evening, everyone. Thank you for taking my question. Vipin, I joined about 15 minutes late. Apologies. So in case my questions are repetitive, please let me know. I'll look up the transcript. So just 2 things I wanted to understand. One is, a lot of participants in this call have already asked about asset quality, the fact that stage 2 is inching up. And we're seeing that across some of the other affordable housing finance players as well. Again, pardon me, but I don't think this is just a seasonality-led what we are seeing today, because somewhere there is an acknowledgement that, hey, in addition to seasonality, which is about maybe rains in the second quarter, there is also some spillover that is being seen from MFI, micro lab into affordable. Somewhere we see an acknowledgement that, hey, there are pockets like maybe Chennai, Surat, Tirupur, right, which are exhibiting some localized stress, again, primarily because of tariffs. So I understand, like in last year, right, but pulled back very, very strongly in the fourth quarter. But this year, is it looking like any different, or you think that this is just one edge deterioration and things will definitely get better once we move into the second half?
Thank you, Abhijit. I think we answered this question, but yes, we have not only said seasonality, we said when overall industry is infected. So some heat gets falls into, entire ecosystem, and that does affect a little bit. But what we have to see, what are the guardrails and how we are reacting to that piece. That's an important piece. Fortunately, the market where we operate, the ticket size is in the tune where we can apply various norms, and there's a reason though there are certain slippage in certain buckets, but when you talk about overall number, whether it's a credit cost or this thing, we are able to maintain. So dynamics keep changing month on month, quarter on quarter. That's bound to happen when you're running a long run business. So does it going to affect it? It is only help you to prepare better. That's our thought. That's our philosophy working around that piece. We have seen since you appreciated the last quarter of previous year, and I think that was the obvious reason that preparation helped to that side. So I think that keeps building our capacity and appetite to face these kind of changes which is happening and which are very dynamic particularly. So I don't think that we have to overly concerned about it, but yes, operationally how to execute, that is more important, that be on the job. And maybe that's why this set of customers, if he moves to 90 plus, bringing them will also become easier because the tools which are available in form of surfaces or in form of LTVs and all, and that's being used very effectively. And this you can see also, even if there is some inching of which happen in certain DPD, certain buckets, but if you see the GNP is very well in control, that happens particularly that way. So instead of going month-on-month basis or quarter-on-quarter basis, there may be little flip here and there, but our focus is more on execution and we are confident around that side.
Got it, sir. And then the last question I had is, earlier in the call I saw that, you continue to guide for that 30-35% year-over-year growth in AUM. I think which is a very good thing, and I think that at our current size, which is about 9,200 crores of AUM, we should do that. Having said that, so don't you think, given that, at the overall industry level, if there are some concerns emerging, maybe, and also because we have a good exposure to the self-employed customer segment as well, don't you think, it will be maybe a little prudent to slow down a little bit, see how things evolve, and then kind of maybe grow strongly after things are settled down? So just wanted to hear your view on how we are approaching this. Given that for one thing, that the self-employed customer segment, right, in case some of the things that we've seen in the last 6 months continue for some time, we will be a bit vulnerability going ahead.
So I think to give the business of linking it together, I think the companies on day one are incented to focus always remain to self-employed because the market that we operate, the product what we into that shows maximum impact on particularly. And while we were executing on that side, we also on skill for underwriting those set of customers and how to deal in terms of challenges that happen. So we faces the time of COVID, the time is what happens in the business side and how the tools are developed. So one side there is a mechanism which is on the underwriting side, other side, and there's a mechanism of collection and of getting help also. So what basically only we project in terms of the going forward guidance and all. And that's the main thing. There is a reason that we say that growth is going to remain down in 30-35%, and credit cost is going to be down in 40-50 basis. But we are focused on and they'll keep doing it. And as I mentioned, when we need to see the business, see the business on a monthly basis of couple of months. It's for a long range, and your burden should go down, keeping in mind that you get the right of on that. So we get a job. This is job on the field in terms of operation as well as execution. Both sides provide making sure that handling and other side ensuring that the collection is as well as itself. This has to remain there.
Got it. And so just one follow-up on that. I'm just trying to understand, in this repo rate cycle, right, repo rate cut cycle, we're not seeing any affordable housing finance companies cut their PLR rates as yet, right? Won't it be more prudent that in an environment like this, maybe cut PLR a little bit, right? Take better credit quality customers. Because at the same time, right, our BTs have not reached up, it is still 94.5%. BT outside the industry level are going up. So maybe slightly lower pricing, it will be slightly lower profitability, cater to a better customer segment during the environment that we are today.
Okay. So I think the model would be well executed. The model is where we deal with ticket sizes basically, right? And again, the market is particularly. What what you're saying, there definitely is able to some different ticket size, some different set of market. There is competition is very different way and format on that piece. And I think largely the model has been created, as I mentioned, this is some of those things. Again, as new customer comes, we definitely, pass on what need to be passed as per the system mechanism. There our business rule engine and our people model does work on that side and give them that output particularly. So that passes will come according to the time.
Got it, sir. That's all from my side. Thank you for patiently answering all my questions, and I wish you anything else.
Thank you, Vijay.
Thank you. We'll take our next question from the line of Saptarshi Chatterjee from Grow ANC. Please go ahead.
Yeah, thank you so much, sir, and thank you for the opportunity, and congratulations on good numbers in difficult times. Sorry for asking again on the asset quality piece. Just to understand that fundamentally, whenever there is a problem in the environment, it happens sharply, and then it takes a couple of quarters to repair the damage. But generally, as you were mentioning and other players are also mentioning, that it should be better in couple of months. So what is giving that confidence, or any on-the-ground insights that is giving us confidence that it should be better in couple of months in that way?
So what happens generally when customer moves from one bucket to other buckets, so there is always you have to wait for a couple of months to realize that it comes back basically. So if it is in bucket 2, bucket 3, so customer has 2 options. Either to pay back and become a normalized, or other option if he is not able to do that, then he move to the next bucket, which is the NPA bucket basically. So as NPA bucket starts moving to the NPA bucket, and then definitely the other triggers which comes into the function, whether acquisition of property, using the tools around that piece of safety and all. So where then customer reach to the level of taking a conclusion and right decision basically. And those decisions are to close the loan on various basis. Either will dispose his asset and settle it down because of the end of the day he has to pay interest and principal of the institution back. So that decision more becomes more effective in that side. And in case it doesn't happen, then obviously then another 6 to 7 months, sometimes 8 to 9 months, that you are able to progress and sell the property market. So the decision point, because everyone knows that it's my asset which has to keep it in place. He knows that as far as possible it can manage it, let me manage it out. So those decisions come at certain level. Many of customers they do come back after being into full bucket for couple of months, and that doesn't happen, then you do get triggers basically. So these lead to some kind of output in that way, and on basis of the trends, past trends and what data says, people are able to give you ideas a couple of quarters or couple of months to be able to track it back.
Got it, sir.
This is simply a question about why in industry what happened, so I thought to give you more as a focus center on that.
Very helpful. Yeah, very helpful. And on the for us, any customer level color, is it happening on any customer profiles where income is impacted, or any vintage of loans where the delinquency is happening, or any regional level problems? Any color on those asset quality?
So slight here and there keeps coming basically, and it's not because of current times or specific times. This is a trend. So if we are maintaining the GNP of 1.2, 1.3, what we are showing it from last so many years, it is not that during that time everything was neat and clean and serving something has happened. So when we are operating in 300 branches, executing this kind of set of customers, every time we find some challenges and trouble around that piece. For those set of customers, then you have to have a very clear understanding what are the tools need to be applied at what time. That's a learning that we learned by underwriting 2 lakh customers in the last 10 years.
Okay. And last piece is in terms of competitive intensity versus 1 or 2 quarters back, is it higher or similar or lower? Any color on the competitive intensity part?
That remains almost same. I didn't find much of change. It does not increase or decrease, but almost remains same. There are a set of competitors which are always existing, coexist together, and there is always a push and pull effect to a certain level. And I spoke this thing last time also, more than a customer, the intensity is more about pushing the people from one company to other. That is a more a role which competition plays around. This is the trend which has been observed.
Okay, sir, great. Thank you so much and all the best for future.
Thank you. Thank you so much, sir.
Thank you. We'll take our next question from the line of Vaibhav Lohia from CFM. Please go ahead.
Hi, thanks for the opportunity. So I just wanted to understand what is the aspiration for the next 3 to 5 years. Like before, we have grown around 40% CAGR for the past 3 to 5 years. So, like, where do you see yourself in the next 3 to 5 years? And we have this question.
So next couple of years, what we feel, we want to grow in the range of 30-35%. That is our thought, and that's the way we are trying to build our model, businesses, and our structure accordingly. So this is something what we are looking for next couple of years.
Okay. That's helpful. Thank you so much.
Thank you. We'll take our next question from the line of Siddharth Chandrasekhar from SJN Securities. Please go ahead.
Hi, sir. Am I audible?
Yes, please go ahead.
Okay. So my first question is about our lab business. So what is the maximum and the minimum state charge to the customer, and what is the LGD portfolio? LGD.
And rate what we are charging is anywhere 13 to 16.5-17%. Again, depending on the model, basically, police what the actually.
So, on the PD event for this lab customer, generally, PD of this customer remain higher by about 20-30 basis points. But on the fact that they are quite lower LTV, so our LTV for lab business at about average about 45%. We see that LGD remains lower than the home loan cases. So on that basis, rate cost between home loan and lab is pretty much similar. And the PD and LGD.
Okay. So when it comes to that, when once the portfolio move to an NPA, right? So where is the maximum probability taking that record, right? Is it because you are selling property or doing a settlement or using free assets?
So generally, so given the fact that we have access to the SARFAESI, we have seen historically that if the customer moving into an NPA bucket, so we like invoke our SARFAESI process, and wherein customers generally comes out for a settlement. They call their friends, family, and like offer for the settlement. And generally, this can remain for their about 85% of the total NP cases, and remaining 15 cases we have to go for auction and close the loans.
Sir, usually this happens, right? So we usually value some metrics to some value to one property, but when it comes to the auctioning of these things, right? We might not get the tax value, right?
You're right. Yeah, please continue.
Yeah, that's all. Sorry, yeah, you can go.
So I think that generally if the customer is coming for settlement, then the losses remain lower in the range of 9 to 10%. But in the rare cases, wherein the settlement couldn't be concluded and we have to go for auction, and those are very rare cases because of some family dispute with the customer, wherein he is not able to sell the property. Losses got slightly higher in the range of 22 to 25%. But at a blended level, since the cases of auction are very limited to the tune of about 12 to 15%, the overall LGD remain in the range of 11 to 12%.
Okay. That's helpful. So the second question is about our off-book strategy. So what is the spread that we earn from our off-book, whenever we do a co-lending or assignment?
So in off-balance sheet strategy, we generally do our LAP loans only, both in DA and the co-lending. So our average yield on the LAP portfolio is close to 15.5%, while average cost of fund is about 8.5% for the LAP book. So broadly, it is about 7% margin that we get on this off-balance sheet portfolio.
And on-balance sheet also we do the same?
On-balance sheet is also same, but it includes both the home loans and LAP. So obviously, also on the home loan book, the margins are lower, and the LAP, the margins are similar at 7%.
Okay. Sir, is there any thought process that you have given, basically like our capital adequacy, right? So it's right now it's beyond 50%, right? So is there any thought process to be time being, slowing down off-book strategy and using a better capital than we handle, right?
function of AI exactly. So it's a function of various funding sources that the company needs to bank on. So as a matter of diversifying our funding sources, we have developed a strategy that we will keep a one-off book in the form of balance sheet, and that strategy says that weekly in form of DA we will raise about 16-17% of our total funding. And then we will go to 10% of the total book at this point of time, our processes. So these, balance sheet sources give you very long-term funding, which you generally don't get in the form of term loan. So that's how, it is also good to keep a blend of both on book and off book.
Okay. Just a last question. So any update on the writing rates discussion?
So, our last rating update has happened in July 2022, and we have about 2 years from the last rating update. So we expect that once we conclude the vintage of between 18 to 24 months from the last rating upgrade, we will be in position to rating another rating upgrade. We will make one of those soon before we can change the rating for that.
Okay.
Thank you. We'll take our next question from the line of Aditya Pal from MSA Capital Partners. Please go ahead.
Hi, sir. Thank you so much for the opportunity. Great set of results. Just wanted to quickly understand, I joined 10 minutes a bit late on the call, so I don't know if you've already answered this, but at the cost of operation, I'll just go ahead and ask. So when I look at your 30 plus stage 2 and your GNPA, 30 plus and stage 2 have increased, but GNPA has not increased that much. So what is it that we are doing that we are arresting the slippage and not letting it fall in the higher bucket?
In stage 2, as you said, that the customer remains very sticky. The customer has one or two EMI, they generally able to develop a position to all of EMIs together and come out of the stage 2. So, and while moving to the stage 3, everybody has the concern that if they move to the stage 3, then then the company will move to 70%. And the company is also very strong in terms of recovering money out of the overall NPAs. So that's why you are seeing some accumulation happening in stage 2 for the time being. But the moment the overall scenario will improve, either these cases will go to some extent. In case they move to the case, we will be quickly looking at our legal recovery process and do the resolution of the same.
Just one last point. Have we taken any write-offs in first half of 26?
So we have a very stated write-off policy since last 4-5 years that any account which move into NPA bucket for more than 2 years, then we do a write-off. So in this last quarter Q2, we have written off about 5 crore of such NPAs, but parallelly we have recovered about 3 crore of NPAs that we have written off earlier. So that's a regular churning that keep happening between NPA bucket and recovery out of these write-off accounts.
Understood. And so last year in FY25 Q2, we had said that we had some leadership transition in our Madhya Pradesh state, that the state head and branch head had moved out, and we were facing some difficulty, and because of which asset quality had spiked up at that point. Do we see that the issue with that state has been resolved, and we can expect now moving forward a resumed growth rate, what we are seeing now?
Yeah, around 7-8 months we are able to hire a new leader, and I think he's picking up. Yes, we have given gestation period to that gentleman, and it looks the things are on track, and we are optimistic about the future, the way MP looks going forward in terms of output that we look forward. So the team is stable now largely. The question what we talk about.
Perfect. Thank you so much, and Rupinder and Ashish, wishing you all the very best.
Thank you. We'll take our next question from the line of Meghna Luthra from InCred Equities. Please go ahead.
Yeah, hi. Thank you for giving me an opportunity. Sir, sorry, even I joined a little late. I'm just taking.
I'm sorry, your voice is sounding muffled, Meghna. Meghna?
Can you hear me better?
Yes, please go ahead. Yes, we can hear you.
Yeah,
Please
hi.
go ahead.
Thank you for the opportunity. Sorry, I joined a little late. I'm just taking the previous question ahead. Can you give some color on the process of recovery that starts once an asset is in stage 2? And my second question is, when with an AUM growth of around 30%, so do you expect the LAP proportion to change, or would it be at a similar level?
I think we have an intent to continue with the 60-40 ratio, though there is a slight gap between 60-40. We are 57-58 and 40 to 41% on the other side. So we have an intent to continue with the 60-40 ratio, where 60 is the housing and 40 is the LAP. That is intent going forward also. This is the way the model has been created at markets where we operate around particularly. So once customer move to NPA, basically the location which is from 13 to that time you have to give in terms of certificate or something, 13 to, and then we go for the DA models and acquisition copy. But it has been observed more than 80%, 83% of customers, once you remove the certificate, they try to partially as a process of settling the loan amount. That has been seen there. So the entire process, which is normally 9 months, only 20% reach to the level where you have to be to the extent, and then some part of that you have to progress and correct.
Okay, that's very helpful. Thank you, sir. That's all from my side.
Thank you. We'll take our next question from the line of Sonal from Mons. Please go ahead.
Thanks for the follow-up opportunity. This quarter, highlights the credit control that is applied during Q2. Also, this from the how the delinquency is million volumes in LAP. Any agency that I see where the delinquencies are higher, within the team. Similarly, on the self-employed and the salaried customer segment. And when do we do ECL reset every year?
Between HL and LAP, I think there is, if we are at 1.2, LAP will be around 1.3 and HL be 1.1 in terms of this number. So there is around 18-20 bits of gap which does remain between HL and LAP when you talk about the numbers around that piece particularly. As for the tweaks that we keep doing it, that's a continuous process which happens in our BRE, business rule engine, while settling with customers. So irrespective of timings and all, wherever we find that some branches we need to tweak in terms of BRE, we try to make it up. There's a mechanism internally where we use our data science team to give an output, and this is that BREs are updated. And on basis of that, those tweaks happen in terms of in those markets, how the things has to be tweaked, whether in terms of FOIs, whether in terms of certain segments or geographies, all those things that we have to keep in mind. That's another thing to work with that particularly. So I think you talked about what was ECL reset.
So ECL reset, you could say, briefly, it's a model which we are running since last 5 years, and the model is behaving well. So whenever situation has happened, we have done some tweaking, built some assumption to higher ECL. But since last 3 years, we have seen the model is behaving well, and there is no change in assumption which is applied briefly, and we compute ECL every quarter. We compute every quarter.
Okay. So just another question is, what is your street book currently on the assets? And how do you see the spreads evolving? Because we speak about the exact basis of cost of borrowing is around the rate of interest. So I said would ideally, we should go to about 6.6%. So some commentary around that, and how do you see yields moving from here?
So about 50% of our book, loan book, is at a variable rate, and then we have about 5% of the book which is at a semi-variable rate, where the reset will fall start in from FY2027. And then remaining 50% of the book is at a complete fixed rate. On the liability side, as you said that there will be some reduction in the cost of fund, which will flow to us in the tune of 20 basis points. So we expect that by year end we should be reaching overall cost of fund at about 8.3%. So there will be some temporary expansion in the margin. You are right, like to that extent.
Okay. Thank you, sir.
Thank you. We'll take our next question from the line of Shailesh Kanani from Centrum Broking. Please go ahead.
Yeah, good evening, everyone. Thanks for the opportunity. So I went a little late, so I don't know if it is answered or not. So I have three questions predominantly on growth and demand. So the first question is, some peers have kind of called out macro softness impacting disbursements. So and we have posted decent growth, right? So any qualitative differentiation you can talk about in terms of our customer base or any geographies or something on that? Second question is with respect to, have you observed any moderation in lead conversion, sanction to disbursement ratios or approval turnaround times in recent months? And third, is the demand strength you are witnessing more in urban centric or broad based across semi-urban and rural areas?
So we are spread largely into tier 3, tier 4 markets. Our most strategy is not in urban markets, but those markets which are semi-urban. That's the focus area. Areas around that piece. And that again catering the segment which is more on self-employed who are dealing into those vicinity. They may be a small cloth merchant, street mart, small mechanical shop, whatever it is basically. And these are the businesses which generate income on weekly, monthly, even daily basis basically. So that is the way their income generates on that piece, and their ecosystem is very segmented to those vicinity where they are operating it. They are not something which is going to get infected by situation like trade wars or exporters of that piece basically. Since they are all self-employed in that category, and most of them they are something who are now not been a part of a strong banking ecosystem particularly, and it's a segment of customers who want to have their own house or take a small loan to fulfill their needs and requirement of that working capital. Those things are the set of customers we try to operate that piece. So we find this is a huge humongous market, and as we go deeper, there's a scope of improving that piece. There are some challenges that does come on the basis of sometimes seasonality or something which is picking up. And that each, month to month, sometimes quarter to quarter, by them basically. Not just things which can happen. So those things you do when you into the operational activity. But when you see overall output, I think we do much of it on that. Yes, when it is teacher, we always have where the focus something is not there because market is not booming. We are not affected because of what is happening around basically. There is more impact on that. It keeps happening particularly. So this is the trend which is keep happening. Not only in this time, but any movement back of course. When you have an expanding operation in one to nine geography.
So anything on that? Anything we have seen moderation in terms of lead conversion or sanction disbursement ratio or anything around there?
Losses remain almost as per the plan. Yes, you keep off your understanding at the end. You'll always find that you balance your own those things. The sanction to disbursement is also equally good. So little up to 10 days coming around that, but nothing which we have to be concerned about or we would change the strategy on that.
Okay, and sir, in terms of demand, it is broad based, right? That is the fair assumption of our states going to show up.
Indeed, yeah.
Okay, thanks a lot, sir. That's all.
Thank you. Ladies and gentlemen, we'll take that as the last question for today. I now hand the conference over to management for closing comments. Over to you.
Thank you everyone for taking your valuable time for attending our earnings call. Also, an audio recording and the transcript of this call will be uploaded on our website in due course. Looking forward to hosting you all in the next quarter. Further, if you have any questions or require additional information, please feel free to reach us out. Thank you so much and good night. Thank you.
Thank you, members of the management. On behalf of ICICI Securities, that concludes this conference. Thank you for joining us, and you may now disconnect your lines.